Welcome back, everyone. This series, Bitcoin Road to 200K, is where I ignore the noise and look at the forces that truly move Bitcoin forward. Not price drama, not fear headlines, but the actions that shape the next stage of the climb. And over the last few days, fear was everywhere. Red charts, liquidations, retail panic, people selling their future for the comfort of the moment. But while all eyes were watching the price crash, something far more important was happening behind the scenes. Some of the biggest players in the world used this moment of panic to prepare for the next leg up, and that's the part the charts don't show you. So today, let's look at what really happened. While everyone else was screaming crash. Hit like, subscribe, and let's get into this week's episode. When the entire market sees red, two groups emerge. Group one, the emotional sellers. They watch the price tick down and think, I'm losing money, I must protect myself. Fear hijacks logic. Their timeline shrinks from years to hours. Group two, the strategic accumulators. They see the same chart and smile quietly. Because panic isn't a signal to exit. It's a signal that weak hands are handing over their coins. Bitcoin history shows the same pattern: 2015, 2018, 2020, 2022. Every massive long-term move started after a panic wave. Crashes don't destroy bull markets. Crashes cleanse bull markets. And what happens during the cleanses? Strong hands replace weak hands. Serious capital replaces fragile capital. And when you see fear at 90%, that's not the end of the story. That's the beginning of a new ownership structure. Bank of America has $1.7 trillion under management. When they say 4% allocation into Bitcoin is appropriate, that's not a comment, that's a capital routing plan. 4% of $1.7 trillion is $68 billion. That's more than 50% of all daily Bitcoin trading volume from one institution at one small allocation. And here's the key psychological twist. They announced this during a correction. Smart capital doesn't buy tops. Smart capital buys liquidity events. This is the moment where strategy meets supply. Bitcoin has a hard cap. Trillions do not. Which one do you think moves first? Central banks have a very specific language. They rarely say, we love this asset. They say it fits strategically. And when a central bank says Bitcoin has low correlation and fits a large portfolio, that is the institutional equivalent of, we are preparing this asset to enter the reserve conversation. We are witnessing the earliest chapter of reserve diversification. Gold took centuries to reach that status. Bitcoin is attempting it in a decade. And once Bitcoin is considered a hedge against global monetary risk, the flows become national, not retail. That's when the number go up machine stops being a meme and starts being a macro mechanism. Dubai didn't wait for Wall Street to agree. They moved first. Why does that matter? Because global capital moves differently today. Money doesn't stay where it is tolerated. It goes where it is celebrated. Dubai now positions itself as crypto-friendly, with regulatory clarity, adoption-focused policies, and as a geopolitically neutral cash flow hub. They are building the infrastructure before the adoption wave hits. This is what Silicon Valley did in tech, and now Dubai is doing it for Bitcoin. And while some countries fear losing control, Dubai sees it as a chance to lead the next monetary era. That's a position many others will want to copy later, but early movers reap the rewards. Amazon does not bet on hype. Amazon bets on inevitabilities. When they hire for Bitcoin and crypto ecosystem lead, that means they are not just integrating Bitcoin, and they're building around Bitcoin. Because here's the reality. E-commerce needs international, fast, secure payment rails. Bitcoin offers that without middlemen. Even if Amazon doesn't announce it tomorrow, teams don't get built unless a strategic future use case exists. They are quietly designing the rails of the future marketplace while everyone else is arguing about today's dip. Crashes shake out the impatient, but innovators take notes. Let's recap the four signals. First, legacy banks open allocation. Second, central banks evaluate Bitcoin as a reserve asset. Third, governments embrace Bitcoin infrastructure. And fourth, corporations build Bitcoin use cases. Tell me a single cycle in Bitcoin's history where this combination didn't lead to a major reprice. Exactly. Retail sees candles, the powerful see cycles. Retail sees danger, the powerful see opportunity. When institutions buy red, the top is not in. The base is being formed. Every dip you survive is a transfer of future wealth from fear to conviction. If you found this breakdown helpful, hit like, subscribe, and tell me in the comments which of these moves impressed you the most. Which one did you miss, while the chart stole your attention? I'll see you next week on the road to 200K. Stay focused, stay calm, stay convicted.